Well, good afternoon, everybody. Welcome back to another episode of the Industrial Real Estate Show. I am very excited talking to internet sensation Rohde. But before there's a better lead up to that. Industrial real estate investor, lawyer, the only lawyer that I'd actually recommend in the U.S. anyways. Only lawyer I'd recommend. He's an author, just past 10,000 subscribers on YouTube. If you haven't checked him out, please go and subscribe because he puts out some killer content. And he's become a good friend over the years as well. We've got to hang out a few times with the families. We talk fairly regularly. So I'm honored to call Ron a friend as well. But Ron, thanks so much for joining me on the show.
Thanks, Chad. Way too kind of an introduction, but if I can live up to half of those, then I'll be happy. But yeah, absolutely. Good friend Chad, and appreciate all the support over the years. And YouTube is a grind, and I don't think I would have done it as well or as long without your support. So I really appreciate it.
Well, that's a two-way street because you're right. It does take a lot of work. It takes a lot of time, and having a little bit of encouragement along the way certainly goes a long way. So
Yeah.
I know that there's a few people in the insiders group that are working on starting channels as well. So I'd encourage you, reach out,
Yeah.
find other people.
I love chatting about it. If you want a different approach or angle of what the channel should be about, it's unfortunate too, or fortunate. During our tenure, we have seen people start channels, do it for a few months, do it for a year or two, and then fade away. And that sucks, like it kind of hurts. It crushes mine that they, I don't say gave up, but they pivoted to something else, or they couldn't hold the interest. So if you're interested in it, it is the platform of the future. I do think video and authentic online brands is going to be what trumps SEO, websites. It's going to be your online brand, and AI cannot replace that. And websites are going to be lower value, but authenticity and
Yeah, I completely agree. And it is a long grind. You and I both started in 2020, right?
2020
It was
COVID. Yeah, after COVID, that's when we started.
5 years. Like that's actually pretty crazy. So
Yeah.
if anyone thinks that it's an overnight success story, it is not. It is grinding away when nobody's watching, nobody cares, nobody knows anything about you. It's that really long grind, and it's doing it consistently over time. So if anyone is interested in doing it, I completely agree with Ron. I think it is the future of content. That's where you're going to have the opportunity to provide an authentic voice. And you've done that. You've done that very well by blending your experience. I saw that you had just posted that you've now done over $25 million worth of industrial real estate deals.
Yeah, we sold a deal last month, so that was like another 5 million. So
Congrats on that, by the way. Well,
yeah.
that's primarily what I want to jump into. But the one thing that I want to distinguish as well is that that's your own capital there. Because there's big numbers that get tossed around in our industry. Like you hear of a portfolio sale that's several $100 million, or it's $1 billion portfolio sale. But there's a ton of people on the payroll on that. And it's probably the person even making the decision is on the payroll as well. Whereas you're putting your own capital. So 25 million in context to a multi-$100 million sale portfolio might not sound much, but that's you put at risk with your own capital and probably even some other people's capital along the way as well.
So we don't raise like syndication 506. There's no LPs. It's all just partners equity. So for that, like 25 million, I'm between a third and 50% of those on the deals. So, that's all leveraged. We have debt, but obviously there's still a good chunk of equity, and it's a lot of gain because we're buying, not exiting anything less than a 2x equity multiple plus cash flow.
That's pretty impressive. So is that the number that triggers it? So if you're at a spot where you can get a 2x,
yeah,
you're like, okay, now it's time to sell.
Pretty much. I mean, unless it's a real clear value add, get in, get out. And I think, I'm happy to talk about it more too, but I'm kind of at a inflection point where I basically sold, almost everything. Like a lot of the stuff that I had is all gone. So right now we have 3 properties, because like this year we sold 3 and bought 1. But the numbers were off too, because like we sold big deals, and then the one that we rebought was small. It was like $1 million deal, so it was a small one. But uh, I'm at a capital heavy stage, and I've been talking to one of my partners and one of my friends who does a lot, and was like, we really should be focused on this next stage of buying. What do we want to buy? What do we want to own? What are the benefits that we've learned from this first, fund or series, if you will? Because there's definite lessons that we learned, and we want to try to expand on the good and be very purposeful about what we buy next. Now that we have some track record and some wins, but like holding long term, I don't think would have been a fit when we had like three partners on a deal, because we just have different goals. And like somebody gets a little bit annoyed at this or says like, "Hey, this is a great return. Like somebody's paying a six cap. Like we should just take it." But then in our head, we're kind of like, maybe we should wait for cap rate compression and sell at a four cap. But that's also kind of being greedy, to wait for things that may not ever occur again, right? Not to say we're unhappy with the outcomes, but whenever you have partners and you have valid, legitimate concerns, I didn't necessarily want to buy out the other partner at that valuation. So it's easy to just say sell. But on this next go around, I think maybe me and one guy who will be very aligned about the outset of like making this more of a forever hold, more of a longer term, like not a quick flip. Just hold it for the cash flow, buy really high quality real estate. Things that's like, oh, they've got 5 years, 4 years left on term and another 5 years renewal. Only then would we look at like redeveloping the back half, or what we would look at paving this in 9 years. That's how I want to start thinking about things. So buying when if we can get into a market where the buyers have leverage, extra land becomes basically bonus. You don't pay for it, but it just becomes extra. And then in 9 years or 5 years in the cycle, you can monetize that additional land. Um, so, so that's where I think, right? Because it's encumbered by the existing lease. So single tenant, they have
Mhm.
the whole thing, even if they're not using it. So it's only until they're at a renewal or they vacate that you can monetize and kind of cut up a site or improve a site in between tenants. That's kind of our thought process. So.
You mentioned at the beginning of that you had learned a lot of lessons through that cycle of sourcing acquisitions, probably writing on a few and not getting them, closing on the ones that you did, running it through the hold period, the property management, the ownership, the asset management, and then the disposition. What are some of the
Yeah.
lessons that you've learned through that?
So on the underwriting speed, somebody tweeted about it too, but I think that is 100%. I co-sign that. Speed to offer and underwrite is critical, because the sooner you can get a deal, and if you're gonna buy on their uh, asking price, you got to be fast. You got to be the first one to make that offer and first to get a contract out. Maybe LOI, a signed LOI is kind of binding, but speed on that allows you not to waste bandwidth, toying with a site or like thinking about things. It's be really decisive, underwrite, make the offer. And, if they agree, then go under contract.
Yeah, anecdotally, I can relate to that as well. I've had a number of owners that I've talked to over the years that would say something to the effect, if multiple offers came in, they'd say, "Well, this guy wrote first, so we'd like to actually give him priority." Like there is
Yeah.
that almost that obligation that some sellers feel, whether it's justified or not. They just feel, well, this guy was the first to the table. He's obviously the most interested and ready to go. Let's give him first priority. So there is something to be said about being quick on that. There's also what I usually say to people that want to become investors in industrial real estate is twofold. I include that part as well, is that you need to be really quick once you want to make a decision. But I also say you need to be very patient until that opportunity comes, because there's a lot of garbage that comes out. There's a lot of overpriced properties. There's a lot of properties that potentially have a lot of hair on them that you might not even uncover until you spend $10,000 on due diligence. So you need to be very patient. When you decided that you wanted to get into industrial, how long did it take you to do your first deal?
Uh, Probably 2 years. Um,
Hmm.
I don't know. I would say when I committed, my first step was to sell. So it's like I committed and then I was selling residential stuff to get cash. So once I started selling, I was underwriting and looking at stuff, but I didn't do put money into a deal until 2 years after.
I'm glad you said that because I didn't know that story and I kind of put you on the
Yeah.
spot. And you could have been like, yeah, no, I bought my first property in the first month, and that would have completely destroyed my thesis on that. So I'm glad you said it took time because I think that is a powerful lesson. You did have to learn the industry, and you've got background as a lawyer, you have background as a real estate investor. None of what's out there today. There's resources out there. There's people other than you and I that have written books. There's other great videos out there. There's more great content. Back Go back to when you decided to first invest. How were you figuring out the industry? How did you
Yeah.
figure out not from a law
So
standpoint or real estate metric side?
so I looked at deals that had gone full cycle. So again, backing up a little bit, when I was making this decision, I already had a 6 houses, 6 SFR. Some were free and clear, but they're all like working class, like for DFW, pretty cheap prices, great cash on cash, a little bit management intensive. But I had a property manager, and so life was good. Like I don't even know what the numbers, but I bet I was making like 3,000 a month net cash, and I was like, "Man, I'm so happy, like, this is great." Um, but at that time, that was what I had, and I did a survey based on what asset classes I was aware of, and so being a lawyer, I was exposed to everything, but I just looked at the press releases. I just looked at that sticker, exit price, and I tried to work backwards of, "Okay, they sold this building for $42 million, but what did they pay? And what did they do to it?" Because I understood intuitively, like, you don't just wanna just go for the highest exit price. I wanted to go for the biggest margin, um, and so, yeah, I mean, I wasn't quite like looking at newspapers, but I was going online and doing research because, yeah, YouTube wasn't a thing. I don't even think there's a lot of books, not on specific asset classes. The books that I had come across were training for commercial property managers. So I actually had a textbook on commercial property management. Um, Guides, just it was like a textbook on how to be a property manager. So I was skimming that one and I was looking at the intros to each asset class, not so much for the management side, because that was like really detailed about setting up estimates of your inventory for light bulbs in an apartment. Like, it's just really weird, crazy stuff like that. But then I just started looking at the numbers and saying like, what has good margin. And what I decided too, what was really important to me was long leases, triple net, where I was kind of sheltered from property tax increases and insurance, at least on a year to year basis. And then I wanted simple tenants. I didn't want office. My parents used to have an office building, but they're almost just as picky as residential apartments. Or residential investing because where people live. So I didn't want those that were high touch. So I really kind of settled on industrial because it checked all those boxes, and so it made sense to me to go into industrial.
Yeah, I think that was a similar journey to my investing path as well. Is that I'd started in residential and quickly realized I just didn't want to be doing it for various reasons. And there's a lot of people that make money in residential or multifamily. So I'm very quick to say that industrial isn't better and multifamily isn't bad. It's different. And I think for the
Industrial
reasons
is
that you
better for
mentioned.
me, and that's all I can do and say, and that's all the authority that I am is industrial is better for me. Um, could I've been successful in multifamily? I mean, I like to think so. Sure, probably, but I also learned the lesson to really focus down and not spread yourself across asset classes, especially when you're starting out. Um, because I didn't want to own one apartment over here and one industrial building there and, iOS down here. So I wanted to be all in on the next asset class. And that's why it took some time too to finish out people's leases before I could put them on the market and sell and raise that cash. And I wanted to have some reserves even after the initial equity to buy something, to make sure I had money to cover repairs and that sort of thing.
Yeah, a great point. Let's jump into where we're at currently then. You're sitting on cash.
Yeah,
Feds just dropped
I know. I'm
25
gonna have
basis
to push
points
it
on the
out
overnight
now.
rate. Yeah, and what did they signal there might even be a couple more this year too.
Yeah.
So, are we entering this scenario now where we could see cap rate compression and a corresponding increase in prices? Or the obvious question is, are these interest rates coming down because there's pressure on the economy and that in itself has an offsetting impact on pricing? Where's your you stick a wet finger up in the air to see which way the wind is blowing. What's it saying for you right now?
Yeah, I think that it's been described and somebody else has used this word of it's a fragile economy. It's not in a recession, it's not broken, but things are very fragile. I think margins are getting thinner for everybody, but the engines are still running. Um, so I don't mind cap rate compression. And I don't even know if there will be cap rate compression. It will just make it more attractive to rescue the marginal deals that are still trading for a higher price, if that makes sense. The sellers are still going to insist, "Oh no, tenant's fine," but people will buy it, they'll transact if that price is the same, but the cost of debt is a little lower, and they're just going to have a little more reserve, a little more DSCR cushion in case that tenant does vacate or has trouble making payments.
One thing that you and I've talked about, and I've certainly mentioned it numerous times, is you have to differentiate different subclasses of industrial real estate because it tends to get painted in one brush. You hear the national industrial vacancy rate is 7%.
Sure.
And that includes everything. That includes every market. That includes the 300,000 square foot distribution center that's sitting vacant. Includes the 5,000 square foot building on 3 acres of land that will never be vacant, and everything in between. Would you look at big box warehousing now? Is that something that you
So
think that there could be an interest in?
yeah, so super funny, timing wise. I'm putting together an offer on a 80,000 square foot distribution. It's actually like a two building set in Laredo. It's full distribution. It's leased. They've got about 2 years left on the lease, which is maybe some concern, but maybe repositioning is not impossible because at our basis, so Laredo submarket in the big box distribution stuff is oversupplied right now. Right, the Class A stuff that's coming online or is online, it's just sitting. Rents are 1050 plus for those buildings, and I think that I am looking at that because it's a bigger lift, right? It's like a $10 million building, $9 million building. Um, so I am looking at a bigger deal. It's funny. So it's funny you say that, just because I
So
think, yeah. Mhm.
let me ask a follow-up question on that. Are you pursuing a property like that because it's too difficult finding opportunities in the stuff that you would have traditionally been more familiar with, like the iOS or small bay, where there's been a lot of pressure on downward pressure on cap rates, even in a high interest rate environment. It's very hard to find opportunities in that. Are you being more creative and more prone to risk just as a result of finding deals right now?
I think I'm open to different kinds of risk and not just trying to buy the quote like good deal at entry, because I think the good deals at entry have gone from, 1 in 100 to like 1 in 1,000. And it's like that's a lot of sifting to get to the 1 in 1,000 just buying at a good price, which is maybe what I've historically done. Um, and I'm okay with lease up risk, say in Laredo market, because I'm bullish on Mexico trade, and this is a prime trucking corridor through Laredo. The tenant that's there, it's still 2 years out. They haven't said anything about a renewal, but I'm willing to kind of take that risk, just because we would also be at the lowest basis for that market. So if they don't renew and if we do have a vacancy, um, we would be able to compete on price based on our basis with all the other buildings. And I think if it's in a recessionary market, there's going to be people looking to downsize or cheap is good. It is two buildings, so you could potentially split it. It's a single tenant now, but if you wanted to, you could split it. And again, I think that that bodes well for lease up risk, because it's instantly demisable. You don't need to do anything really. Um, so there's a lot of reasons why I like that type of lease risk in that market. And then I'm making the bet that, the class A guys, it's going to be a long time before they're below $9 a foot when they're, quoting over $1 more. And I think I can still break even, in high sevens, maybe $8 a foot, eight even. So there's a pretty wide gap, on the rents, and I can just keep pushing that because I'll be the cheapest option. And I think we've talked about it before, right? Death is in the middle. You just get killed in the middle if you have a renovated Class B product that's trying to be Class A rents. If you overpay for A minus product, you get killed there. But if you're brand new, sure, you can kind of command that, or you can hold it, or you want to be the cheapest uh, building. So that's kind
How
of
do
the
you
thought
how do you underwrite your downside risk on that? 2 years left on the lease. Is this one tenant for both buildings?
right now. Yeah.
How do you underwrite the downside risk that that tenant leaves in 2 years and you might have to chase the bottom? Worst case scenario, you got to chase the bottom to be the lowest price. How do you underwrite that?
Yeah. I think we're just looking at vacancy of like a 12-month vacancy, and looking at putting it on the market as two buildings, to just I I think preempt the bottom, because I'm okay to make that a longer term hold to where, okay, well, maybe we just put some stopgap two tenants in, and then if one of them does well and wants to expand, then we could have that conversation, then, and then it kind of reposition, it kind of revitalizes itself back up on the value side. Or if we get cap rate compression, we'll probably make money even with two tenants because they are separate buildings. They just share a truck court, but it's two buildings on either ends of the parcel. Um, so
What, going back a little bit, what did you sell recently? You sold 2 properties or 3?
we've sold three this year. So we sold one in January, sold one in May, and then sold one in August. But I don't know. The most recent one is the one that's more interesting to me. It was an iOS, pure iOS play. It was on market. It was, full commercial OM and everything, but it was listed at like a six cap. So everybody just looked at it and said, "Sure, man. Of course, everybody will sell at a six cap, but not with, Denny's Denny's roadside towing, L dot, it was just not a great company. There was one towing tenant, there was a countertop guy who was actually good, and he's still there. Um, but with the rents, it was just like, this is not attractive. So we went under contract because we liked the market. So we owned other property, we owned two other assets in that submarket. So we liked it, and it's a very functional location. So we looked at it a little closer, and we kept measuring like the area. And in the OM, it said 4.5 acres. And we were like, every time we go to Google Maps, shout out for free Google Maps, the measure was like 4 acres, 4 acres. Well, there's no way we could do it that could get to 4.5. And so we end up writing an offer that was like a price per foot. I was like, okay, if you say it's 4.5 acres, this is our price per foot. But, when we get our survey, if it's not, the price will adjust. And the seller was fine with that. I was like, yeah, the OM clearly says 4.5 acres. Nobody disputes that. So, right off the bat, we got the survey and it was 4 acres. So we're like, okay, that's a quick little haircut there on the price. So suddenly, that cap rate comes creeping up. And then in the PSA, we also put permission to negotiate with the tenant. The towing guy was kind of on the way out. He had very little term left, so we weren't really going to talk to him. He wasn't interested in renewing. But the other tenant did want to stay. They had over a year left. And so we had permission to talk to them, and we basically said, "Hey, man, we're under contract. You're way below market. You can either do a extend and blend with us now, or actually, it was a new lease. We said we'll give you a new lease, fresh 5 years, at this rate, starting now, starting upon closing. Or if you don't, if you don't play ball, then when we buy this, we're going to jack your rent up at the end of your lease, and you probably have to move out. So he saw the light and signed a higher lease. So he paid more for the next 12 months than he would have under his old lease, which was pretty cool. Um, that we got him to do that. And it was like a really good triple net. So that was another thing too that I think turned off a lot of other buyers, was that in the OM, it just listed rents but next to each tenant. Um, without much explanation. And so I think when I looked at it, and honestly, this was my first reaction too, is like that was a gross rent. Because that's typically how you see it, right? If it says,
Mhm.
Chad's soap company, $900, I'm just like, well, that's his gross rent. If it says Ronald Rohde Law, 1412 N, then I'd be like, well, that's Chad's paying gross and Ron's triple net. That's clear. But without that annotation, I think a lot of people just assumed it was gross, and that probably pushed the cap rate like even lower. So a lot of buyers just weren't even interested. Like there was no income there, price was high to start with, and they just completely passed on it. But in reality, when we got the leases, we're like, oh, these are like modified gross. These are a base year, net reimbursement. It was a little bit tricky to decipher, but the answer was these tenants were reimbursing. So it wasn't terrible in terms of what the tenants were paying. So the lift to get them from their current, call it 9,000, 8,000 a month, to get them to paying like 12 all in, it wasn't as much of a lift because they were actually already paying like 10.5 with the reimbursements, if that makes sense. So um we got a new true triple net, like 40-page Ronald Rohde Law special triple net lease that really like, makes it landlord friendly, a lot of landlord discretion and sole discretion. Um, so if you're following along at home, we had the price come down with the acreage adjustment. We had our net income come up prior to closing with that new tenant lease. So we raised him up. So we had NOI go up, we had price come down. So that started to make the cap rate palatable. Um, and then we did seller financing. This was kind of like a last minute thing where our earnest money was already hard. And we just said, hey, seller, like, thanks for all your time and so much time and energy on this, but we can't do the deal. You can have our earnest money. It was like 25 grand or 50 grand. We're like, you can just have it. And he's like, no. He's like, what? He's like, I want you to buy it. He's like, what can I do to get you guys to close? We said, well, we can do seller financing. Basically a neutral or slightly positive leverage. So he financed at 5%. Well, I guess it was very positive, but we told him it was essentially neutral. It was like, well, after this tenant leaves, we're just gonna have enough. You have to lower your interest rate. And he said, well, I still have some debt on the property. And we're like, oh, okay. So how much is it? And he's like, $1 million. So we're like, oh, okay. So instead of our initial equity probably being like 500 or 600K, we bumped it up to like 1.2 to cover his debt and to put some money in his pocket at closing. But he seller financed it. So that was a great cost savings for him to seller finance because no appraisal, no seller legal fees, no origination, no concerns about banks pulling out the last minute. And yeah, so obviously, and then the cost of capital too, right? With his seller financing, the cost was, I would say, significant, but it's like 2% for a few $1 million over a year and a half, whatever. Is it a lot? No. Is it, does it help? Yes. So the last little kicker on that deal is to get seller financing. And then when the bad tenant vacated, we didn't do anything. $0 in capex. I think we spent lawn guy to come out and just mow the lawn. But we had at least, it was a 2,500 square foot like office building on a paved 1 acre lot, private entrance, fenced off from the other tenant. Um, and it had a covered area too, which we got lots of raving reviews because for outdoor guys, like, they're not used to having cover, but it really is functional. It was basically like a 3-sided lean-to, but it was super tall. It was like 20 feet high, so there's just zero chance you're gonna hit it. But it's 20 feet high, and it just got the sun off of your trucks. It keeps the sun from completely fading, you know, plastic or materials. It keeps them dry-ish, right? If there's horizontal rain, it's gonna get wet. It's stored outside. But if it's just light vertical, it actually was dry. So we had people that could store like, you know, cleaning containers. They could leave metal toolboxes, things like metal containers that are not really watertight, but you could leave them out under this covered area because they would stay dry. And it was paved, so it kept clean, like it wouldn't get trapped dust or anything. And it had power outlets back there too. So it was a super functional space, I guess is what I'm saying. There was lights and like with the power, you could like work on a truck with the power hand tools. So anyway, the 1 acre site was like super functional because it had this covered area. It had power, lights. It was almost, like kind of like a garage ish. But we got that lease really quickly for great market rates. So we signed them again on another like 5 year Ron Rohde triple net good lease. And those good leases, they don't really matter until they do. And that sets us up for the exit, which we've been talking to this group, and we said, do we want to sell? I'm like, not really, because now we've got this great cash flowing asset with pretty low debt, and it was like, this is awesome. We're making a ton of cash every month, good tenants. But we did have one issue. The roof got ripped off. We had a bad storm, and the other building for the concrete or for the countertop guy, he has a tilt wall building, like a little 11,000 square foot building, with a metal roof that was old. I don't know what the age was, but it was like a graveled roof, tar and gravel. But it peeled the metal decking like a sardine can. It's pretty wild. He sent us a photo.
What did the numbers look like? What did you buy it for? What did you sell it for?
Yeah, so we bought it for 2.35 for 4 acres with 2 buildings. Um, and then so sorry, back to the sale. So then we had this roof issue. We filed insurance, we got some money. We basically ended up spending about $85,000 out of pocket to fix the roof. We got
Hmm.
reimbursed maybe half of that. Um, and then we got an offer from Blackstone Transport, you know, that partnership. They're loving iOS, and I was surprised they would buy a small deal. But we got them with our fresh leases, with six and a half, 6.4 cap. So it's like 455, 4 million bucks, over 4 million bucks. Which I was saying it works out to like a 6.45 cap, yeah, 6.5.
So you were into it for 1,200,000, and then your proceeds were 2,000,000?
2.5.
And how long did you own that?
18 months.
Wow, that's a home run by anybody's definition.
Yeah, it was a lot of cash back. But it was kind of thing. I was kind of sad to sell it because
Mhm.
we had done. I don't say we'd done a lot of work. We signed a value add was signing 2 leases. Okay, like let's just be clear. It was value, but we did it under the cover of we had this in place tenant. So it's not like we had zero vacancy. We may not have closed if that tenant was absolutely, you know, negative and said like, "I'm gonna move out, like F you guys," or whatever. We may not have closed, because then we would have had 100% vacancy. Um, I don't know. We probably still would have closed. It was iOS, but we signed 2 leases, and that was where the value was. And I will say this to plug for myself is that we were thinking about this type of exit, and maybe not to Blackstone, which was a whole learning experience for us. I mean, I've sold deals to institutions, but as a lawyer, never as a principal, obviously, or not obviously, but I haven't sold to anything bigger than regional groups. And that was our thought was like, hey, we need to be above the mom and pop kind of like Ron Rohde's Investor Inc. In terms of our leases and documentation, because Blackstone really just put us through the ringer, and we thought that we had good documentation, and we did not. We had to scramble for a lot of stuff, and it was just like a six tab Excel list. They're like, here's your due diligence sorted by type category, and it was just so exhausted that a lot of the stuff for us was like, but like fire suppression. They were like, what type of fire suppression? Who installed it? When did you install it? Where's the receipt? How much did you pay? What type of material? Is it, chemical? Is it water? Is it wet? Is it this? What's the pressure? Like, we didn't have to answer that because we didn't have fire suppression in either of the buildings. But for the stuff that we did have, they had a ton of questions. And, like I said, we did the roof. So we had a ton of stuff about the roof. We did replace one HVAC unit. So we had to like go through all that stuff. We've done some electrical work for the tenants. So like not a out of pocket expense, but as a reimbursable repair. But at the end of the day, like it doesn't matter, right? They want all this information about vendors who have performed work on site. And it was just brutal because we would get through it. We had a broker, Chris Wong, Bradford, great guy. And the broker and I, we work through it. We would answer, and they did take a couple of days for us to gather all the documents and signing things and statements. And then we would send back this big email. We were very like proud of it. We're like, oh God, finally got this due diligence done. We would send it like 4:30 Texas time. By 8 p.m. that night, Central Time, they would respond back. And they would respond with more questions that were logical. So it's like, oh, Ron, you mentioned that, you used Yeti brand water bottle. Okay, so since it's a plastic water bottle, did you certify this? And where was the plastic made? And, since, it's not metal, so we're not going to ask you about the magnetic but they were like good questions based on our things. So some analysts in New York got our email, went through it, understood it, and then responded back with more questions that same evening. And that was the most exhausting. Was like, man, can you just give us a chance to breathe without
One
always
day.
feeling like, because it's on my to-do list, like check off. And then by the next morning, it's like right back on the list. So anyway, it was process. It was something new. I think if you don't have to sell to an institution, if you can get the top price from somebody else, like don't do it. It's only if I'm selling like a $300 million portfolio that they're the only buyers, capitalized buyers that can take that down. I would much rather sell to a smaller group that'll pay the same price or honestly, maybe even there were definite points where like, man, for 200 grand less, I would sell to somebody else. It would just get done.
Yeah, well, especially.
Yeah.
Oh, sorry.
Mark.
Mark had a comment. Did you want to join in and ask Mark, or do you want me to read it? I'm happy either one it works. Says couldn't agree more with Ron. I'll read it, but Mark, if you have a follow-up, feel free to jump in. Blackstone just dropped a deal we had under contract off market because we didn't have enough private sewer easements that were several properties over. Due diligence was miserable, too long to explain. Yeah, I echo that. I bought a property off of an institutional group. It was a one-off for them, and it just didn't make sense in their portfolio. It was painful for all the reasons that you mentioned. Everything super scrutinized. Everything was under a microscope. Uh, Compare it to just a private seller or a private buyer. They're just not looking at the same thing. Like I'm guessing they probably wanted serial numbers on your HVAC unit, and they wanted everything in there. Like it gets painful. If you were thinking of that again, and you were preparing to sell to a institutional user, perhaps even as a long-term exit, did that change how you asset manage a
Yes.
deal now?
Yeah, absolutely. And so I kind of hinted at like, we thought we did good documentation, in that I have all my invoices, they're all labeled, they're all dated, they're all property addresses, like suite number. Like I'm really good about keeping documentation, warranties, all this stuff. But, candidly, if I have a guy come and do $1,500 thing, I'm not getting a lien waiver from him. I'm just not. I'm gonna Zelle the guy and say thanks and move on and, keep him in my cell phone. They were like, "Well, where's his lien waiver?" I'm like, "This was like a year ago." And they're like, "Oh," they were like, "Actually, Ron, it was 9 months and, you could still file a lien in the next 90 days." And I'm like, I can't argue with it because technically it's true. And, to me, even to Mark's point, theoretically, it is possible that if they don't have that sewer easement, a copy of it, they may tell you in like reality, they're like, yeah, we agree that it probably exists. But if we can't produce it, there's a risk that somebody will drill a pipe through it and cut off that sewer. And what do? We're screwed. And if they don't have that document, that's a huge risk and it becomes a huge headache for them. So they just don't take 0.0001% chances. Because they're transacting thousands of times so that that will occur. And if it becomes a huge headache, they're like, well, we just shouldn't have bought this property because we had a chance to ask that question ahead of time. So, I understand it. Like you or I would probably buy it without that because we may not get to 1,000 transactions in our lifetime. And so that may never come up as an issue. So I think that, they're good buyers in the sense that they have money and they will pay the lowest cap rates. It's definitely negative leverage. Um, but if you can get the price from somebody else, there's a lot easier to buyers to deal with.
Anything else stand out that would change the way you asset manage now? So just keeping
The
more detailed
leases
records
too.
being an obvious one?
Yeah, the leases was definitely something, you know, a lot of people here use, like, maybe a 15-page triple net lease that is fine, but is not as detailed on CAM, exclusions and inclusions, and so, yeah, you do wanna think about your buyer, um, and it sucks too because if you have the opportunity to produce a fresh lease, I kind of feel like produce the highest quality one you can, unless it's like flex, unless you're a huge multi-tenant where you're like, Ron, I cannot use a 40-page lease. These guys absolutely won't sign it. You're going to kill my business. I'm like, okay, that's fine. But if it's just a question of losing a percentage of your tenant pool based on the lease, I would consider whether that's worth it and does it align with your goals for the property, because having good documentation, having a strong lease does it is a real element of the overall asset. And what I mean is, the paint, the roof, the landscaping, the pavement. If you're spending money on those things to make it an A product or even B plus, I think your legal stuff and your documentation and your your counsel and your like all those things should be commensurate with B plus. It looks imbalanced if you just have this like janky 8-page triple net lease that you say like, well, it's fine, Ron. I just tell the tenants what I bill them and they pay. Like, yeah, well, that's not going to work for other people. They want the certainty that the charges are going to be backed up by the lease. And just imagine every single tenant hires a great lawyer and starts nitpicking everything. That's what higher end buyers want. And if you're positioning the property physically to be for those high end buyers, I do think your documentation and the lease is part of that. Estoppels, tenant financials, following up on those things annually, if you have the right and actually collecting them is pretty important too. Because I feel like that happens a lot. The landlord has the right to request, but a lot of landlords don't always get it, or they don't get a full set of financials. Um, and if you're intending to hold it, you're like, it's fine, Ron. They keep paying rent on time. I have no problems with them. But yeah, it's like, but what does your buyer want? So
I think that's such a profound point, and I don't think enough people, especially someone like myself as a small investor, would really think about that. And I probably would, just haven't been in the industry for long enough, but I don't think enough small and medium investors think that when you're executing a lease, it's a legal arrangement between you as the landlord and the tenant. That's great. And as you alluded to, if your intent is just to hold it indefinitely, then that it stops there. That is the arrangement that you have. But if you are thinking of an exit down the road, think of what the buyer is going to want. I think that that's such a great point to include, because I don't know if that gets factored in enough. And it might just be like, well, let's just get a really simple agreement for ease. Well, that's great. If you don't have any anticipation of selling that down the road, that will suffice. But if you do want to sell that at 5 years down the road, and maybe you arrange to have an option to renew in there as well, and the tenant executes that option to renew, and now you've got this really simple lease agreement and you're
mhm.
trying to sell it, there's probably actually a discount that gets applied in there because the new buyer will say, I've got to fix this lease and this is value add. I expect to be compensated for this value add work that I'm going to
Right.
need to do. So that could actually lead to a discount in your sales proceeds down the road. And that's we're hypothesizing on that because it's not guaranteed. It still
Yeah,
could be
because
fine, but
that
it is a
actually
risk.
that came up on ours. Even with my super duper lease, they brought up a point of some slippage on NOI of spending some dollars that couldn't get reimbursed. And I think it was a difference of opinion. But again, in hindsight, I'm like, I could have written this more clearly to capture that type of charge to make sure it gets reimbursed. But they were like, oh, well, we're gonna under discount the NOI a little bit because of this slippage. And I was like, well, it's not so it's not 100% reimbursed. Basically, in their underwrite,
Hmm.
they said there's some expenses that they're modeling that won't get reimbursed by the tenants. So I was like, that's it. It is what it is. If we owned the property, I guarantee we wouldn't have had that slippage. But the lease wasn't super adamant about this particular category.
Yeah, and in a company like Blackstone, they could have a team of analysts and a team of lawyers and a team of insurance experts, and their entire job is to identify every possible risk under every rock.
They did, and it
So
was kind of funny because they had 2 lawyers. They had, like, the transport and they had the Blackstone. So on our PSA, the Blackstone guys, like, redlined it and sent it back and did all these things, and we started looking at it and kind of toying with it. And then we got another set of red lines that redlined the Blackstone, and that was transport's lawyers. And I was like, "What the f like, you guys figured this out. You have 2 sets of big law, very expensive attorneys, and one guy is crossing out what the other guy crossed out." I was like, which one do you want us to look at? You guys got to figure this out. But I don't say it's embarrassing, but it's just kind of frustrating. It was like, you guys have so many people. We had like 35 people on email chains. 35, Chad. Property
wow.
managers, Blackstone, asset acquisitions, legal, title. It was just insanity. I mean, I did my part to contribute it too. It's like we had 5 people on our side, but it was crazy the amount of people, and they're not all active, but the there's probably 5 or 7 people that are active on the chain. So you step out to lunch and I come back and it's like, how many emails we have for this deal? Uh,
35 people. Like that's almost they're doing that just for like pure intimidation purposes.
well,
Just we're the big dogs here.
and like you never want to be a distressed seller and you don't want to be in a position where you can be intimidated. I go back and forth. This is like not talking about this deal, but philosophically or politically, I really worry about the future where sometimes I feel like I'm strong enough to fund litigation and maybe we go to the courts and we get a just outcome, but we're really not. And like what happens when Blackstone says we're going to buy your property or we're going to condemn the entire block because we own that and you are going to be forced to sell to us at your basis. What, like, is that coming in America, or are we big enough that like we don't get bullied um by the courts and by lawyers? Because lawfare is like is a real thing. So
Yeah, I think so too. I'll step out on that tangent as well, briefly, because I agree with that. I think if you're a very small investor, and I'd put myself a little bit above that because I've got the capacity to fund some amount of lawsuits as
yeah,
well if it came my way, but it's not unlimited. I don't have an unlimited well where I could just go and fight this. And as a small person, and even smaller, like someone that perhaps owns a house and they put all their life savings to scrape up 50 grand so they could buy an investment property, it's unevenly distributed for a big law firm or several big law firms, as the case of Blackstone coming in, that they could just bury that person in legal work for indefinitely if they really wanted to. Hopefully, they'd have the compassion to not step on the small guy's throat like that. But if they want to, it is very concerning that lawfare is a real thing.
yeah, yeah. So that's part of my motivation, to just keep growing and keep going. It's like you've got to always have enough income coming in and enough asset size that you can fight some of these guys off. Because it did definitely cross my mind. Wow, there's a lot of people. There's a lot of assets mobilized on this deal. And if we said like, oh, we changed our mind, we don't want to sell, there would be like literal hell raining falling down on us to fight. Um, so it was just an interesting experience, and would I sell it to them again? Maybe, maybe not, but it was very useful and valuable to learn to go through the process. So
What do you think it took you, and maybe juxtapose it to a conventional buyer? What do you think it took you time-wise and money-wise over and above an average buyer?
10x. I mean, it was maybe I'm like, so I didn't bill my time even though I was like the lawyer. So I had my law firm, kind of represent us. So I had my team doing stuff. Our bill was probably 3x what it should have been in terms of legal fees. And that was with me not billing. So everything that I did was as a principal. I wasn't billing my own partners basically. But if I had my admin chase down stuff and pull stuff from the city or like check this document, they were billing their time. But the bill
Yeah,
was big. It
something.
was it was 5 times, and I can't even imagine what their legal bill would be. I think they said at one point they were over 100K all in for diligence and legal before we closed, and I was like, "Wow." Just it was such a small deal. I mean, I can't imagine they're gonna deploy all their equity because what do they have, like, $1 billion?
Mhm.
700 mil like, I don't know how they're gonna deploy all that equity, either A, buying $5 million deals or so slow, like, maybe all their equity goes to deal costs and fees.
This is one of the most interesting things that I've seen develop in the last 2 years is because warehouse was so overbuilt
Yeah.
and it's the returns aren't what they expected and there's a lot of inventory. A lot of these big institutional guys are saying, "Well, how can we still make money?" Well, they look at small bay industrial and they look at IOS, and that's all owned by small, medium investors. Well, it's changed now. There's a lot of institutional groups now, but these guys have all had to negotiate with guys like you who are like, this is not conventional at all. We just want to sell to like a normal buyer that we're not going to have to go and pull all this information and say that a contractor 9 months ago might still file a lien because he has 90 days left. Like that's not something that comes up in a normal transaction. So it's these big institutional juggernauts trying to deal with small and local investors, and it's such a wild thing to think about because it has never happened before.
Yep. Yep. Um, so we'll see. I mean, stay tuned. If I can help anybody out on a transaction, and I do think though, at the end of the day, they're still real estate investors, so they still get it. They just have a lot more hoops on their internal approval side um, to go under contract. But yeah, it was a process for sure. There's
Well,
no one decision maker. You can't talk to
yeah.
somebody to negotiate or be like, "Hey, this can you guys accept it?" Like, well, we got to write a memo. We got to write, send it over to committee. It's got to be memorialized that we made a decision. And it's like, okay, well, how long does that can take? Like, a week.
Yeah, that makes it fun.
So like if that contractor got deported to Mexico and I'm like, I physically cannot do it. He's in Mexico. He's unavailable. They're like, well, we'll have to get an exemption for that unconditional lien waiver. We'll get back to you in a week whether it's okay or not, or we have to kill the deal. Or they,
Well, at
if they
least
say we'll kill the deal, then I'm like, I'm flying to Mexico. I'm gonna go find this guy.
at least you made a healthy profit on it because that
That's
would have
right.
been remarkably painful if you just broke even to have to go through that all those additional exercises. We're just at the top of the hour. Anything I missed? Anything that you wanted to cover that I didn't bring up?
No, I just finding like more small deals. I'm under contract on a super exciting little iOS. It's 2 acres, paved. It's got a brand new flex building, 6,000 square feet, leased, 9 cap. But it's like so small. Um, I don't know. Maybe we should just buy it all cash, not put any debt on it. But
Joel Friedland in Chicago, that's his mantra is he buys almost everything cash or with very little low
I mean, if the
financing. So
returns are good enough, it's a 9 cap. I would buy that all cash. Um, and it does remove a variable, and then it gives you a buffer that if the economy turns or this property goes vacant, you're not, you have that equity cushion to tap it. Versus if you lever all your properties every single time, you have no you have no cushion, or you have a little bit of equity cushion. So it's something
Are
to
you looking at
consider in these heady times when you have the cash, um, to just buy a small deal like that. So
you and I had briefly looked at a deal in Florida that didn't go anywhere, but we looked at it. Are you focusing predominantly on Dallas Fort Worth greater area, or are you expanding to other markets?
yeah, I think if the deal is big enough, we could go outside, but I definitely don't want a small deal. Um, Outside DFW, because even one other lesson was like to really hone in, if you can be within the same sub markets that your tenants cross shop, that's huge. So like when we had 4 iOS sites within a 15-minute drive, it was powerful because tenants and leasing, and we had just a lot of synergy across. We had a lot of options. Um, and if a tenant toured on one thing and they didn't like it for whatever reason, they wanted to go bigger or smaller. I'm like, oh, we have this. Oh, we have this. Oh, this is coming available. Um, you can almost like trade tenants, but it was useful. And it was like, I don't want stuff in Dallas and Fort Worth. I'd rather double down in one of those markets.
Mhm. Well, you heard it. If anyone's listening right now, you have a deal you want to put in front of Ron, reach out to him. I know deals have gotten done from people that have reached out to guests that I've had on here.
That's
So,
cool.
uh, yeah, it's very cool. I think that was one of the coolest things that I've heard is that they're like, yeah, no, heard this guest. I reached out to him, sold a property. So I think that is super cool. I would love if someone could put a deal in front of you. Maybe I come in on it. You and I need to do business together at some point down the road. So looking forward to that, and also just looking forward to keeping the conversation going. As I mentioned, Ron's got a YouTube channel. We'll put a link to that. Mark Williams, who's also on the call, made some great points. He has a YouTube channel as well. He's based out of Florida. I'd recommend connecting with Mark. We'll put his YouTube channel in the show notes as well. Connect with Ron, connect with Mark. Two great resources for industrial real estate. Ron, look at that. Right at the top of the hour, we close this
Perfect.
off. We put a bow right on it. Thank you so much for sharing an hour with me. Really appreciate your time as
Thanks,
always.
Chad. Good to see you, buddy.